Hello, business finance students. I just want to talk about, some of the concepts covered in chapter 3. And sometimes you might have heard investment banks. What are they and how do they work and what are their jobs? Private placement and federal security laws. And we want to talk about it. As you all know, you did a lot of, I see you students are posting great things about, chief financial officers of the companies. And the reason you are selecting that particular person is because business finance has a lot to do with the chief financial officers of the companies, CFO. They are the ones who take care of the finance of the companies, and that is one of the most important jobs in every organization. Even sometimes when they want to pick their CEO, chief financial officer, is the head of an organization, and under that person, there are several positions. One of them is chief financial officer, sometimes chief technology officer, or usually, companies have technology. Therefore, there are several positions under, another person, let's say, chief operating officer, chief financial officers in organizations have very important jobs, and sometimes even the board of governors of organizations, when they want to find someone to make that person as the CEO, chief executive officer, they usually like the person to know a lot about finance because, as you all know, companies are all about making money. For-profit organizations like that, non-profits the same. If you are the president of a hospital and this hospital is a non-profit, still the board of that hospital board members want to have someone who knows a lot about finance. Therefore, because very important, if the hospital doesn't have enough money, it cannot operate. Therefore, that's why the job of chief financial officer is one of the most important jobs in every organization. Now, saying that, I want to mention one thing today to see whoever who does something today, who is the first person who posts the message on the discussion board where I said Dow Jones. I'm going to give that student, assuming that a student is the first person who posts the information. And that information is today, Apple. You all know the company of Apple. Later, after 4 o'clock, around 4:30, is going to tell how much money they have made in the last 3 months of 2024. Means October and November and December. They are going to announce it. And based on that, the stocks of the company of Apple might go up and down. If it is a very good news, usually the stocks go up. If it is a bad news, means that they say that, sorry, we didn't sell as many as iPhones. That's why we make $10 billion less. They want $1 billion less. Then the stock might drop. Therefore, I want to see who is the person who gets this message. Therefore, in order to be the first person to get that, those 5 credits, 5 bonus points, you have to be the first person who gets that information. And maybe because it comes to the Google, you go Google News, and you put Apple, and then as soon as news around 4:30, you might get that news. They usually wait until they close the stock market at 4 o'clock. That way, the people can analyze things. Therefore, the news will come. And if you are the person, you write a little simple thing. Oh, Apple News was excellent. Their stocks went a little up today as soon as they announced. If you are the first person, you get 5 points, 5 bonus points. Therefore, let's see who is going to watch for this news. You might get the news. Some students might not check. It might be 5 o'clock. Whoever who puts the first message there, that person will get. Post it where it says, I posted at Dow Jones. Click on that and click respond. And then, type and say, I checked it. It is this. And therefore, that's something I wanted you to put a kind of challenge for the students to see who is going to get the news first. Now, we go here and we see that what they are, transfer of funds to businesses. The businesses always need money. Imagine you start your own company. You want money. Where do you get? You have no other option. If you don't have money, let's say you started a restaurant and you want to expand. And there is across, another town, there is another restaurant that you are going to go and buy that one also. You are expanding. Where if you don't have the money, there are two ways for you to get the money. One is go and talk, let's say there is a rich doctor. You go and say, hey, doctor, be my partner. I want to expand my business. You put 100,000, I put 100,000. Half of that restaurant is yours, half of it is mine. And then we can, therefore you are asking the rich person to bring money to their organization. That's called equity financing. That means you are giving half of the ownership of that new restaurant to the doctor. Now there is another way to raise money. And that is going to bank. You say, I don't want, you say you don't want to give half of the ownership to a doctor. You don't need his or her money. What you do, you go to the bank, you go to Berk and Herbert Bank and say you need it, or Summit Bank or Bank of America. You say you need $100,000. You say that there is a good restaurant in another town and another city. It is $200,000. You already have $100,000. You are short by 100,000, and you get the money from the bank. That is called debt financing. That means you are creating debt for yourself. That means you owe money to the bank, $100,000. But in the first case, when you went to the rich doctor, you are financed it through equity. Equity means you were giving half of the ownership. But as you know, when you borrow from the bank, you are not giving half of the ownership of the restaurant to the bank. The whole restaurant is yours, but the bank has claim on it. That means half of the $100,000 you owe, you are responsible to pay the bank. Each one of these scenarios has a kind of advantages and disadvantages. If it is going to be a big, great restaurant and there are millions of dollars you can make out of it, at that time we would say, oh, I wish I had not gone to that doctor. I wish I had gone to the bank and borrowed 100,000 because it's a very profitable business. I could have all of it on my own. However, if it is a bad business, if it is not making money, if it is, first year, or even if it is losing money, you say how nice it was that you didn't go and borrow the money from the bank because you have a payment to pay to the bank every month. But if it is the money of the doctor and you don't make any money, no problem. The doctor says, okay, no problem. We can wait. We are not looking. But in case of borrowing, you have a payment to the bank. If you are not making any money, you have to pay checks every month to pay your mortgage, you pay what you borrowed. Therefore, that can be a problem. Therefore, now we are going to continue and discuss more in details about, let's see, the role of investment bankers. Investment bankers is an organization. Think about, you don't know any doctors in town. If you don't know any doctors in town, and you want to bring more partners, how would you do that? You go to a broker. You go to a broker, and the broker, you tell them that there is a great restaurant here. I don't know anyone. Do you know some people who might be interested to invest money? That broker will look to see what he or she can do to bring partners. He knows a lawyer, he knows a rich engineer, an accountant, a doctor. He goes and brings you money. Therefore, investment banks is when businesses, imagine you have started a very important business and you want to expand it. You have started a business, let's call the business Microsoft, for example. Let's say you are like, Bill Gates, and you are, imagine, young person, 20 years old, and you started a company, you named it Microsoft. The value of your company is $2 million. You need $2 more million. Where do you go to get the $2 million? That's not a little bit money, and no one, imagine, has heard of Microsoft. What you do, you go to you have three options. One option, you go to someone who is, if you know someone who is a rich person, that rich person is just like a doctor, for example. They call that doctor usually, the name, the term used, they call him or her angel investor. Angel investor is someone who is rich, who has some money, wants to get involved, wants to make some money, wants to help you too. Therefore, in that case, you go to angel investor. The issue with the angel investor is the angel investor might be able to come with 100,000, 200,000, but he or she doesn't have $2 million that you need. Therefore, you need to go one step higher. One step higher you go, there are some organizations they call venture capitalists. Venture capitalists are the ones that they like to see some companies that are, expanding. Many of you have seen Shark, tanks. Therefore, that is similar. But investment, that those venture capitalists have, so let's say, a lot of money. They are looking into some smart people who are investing money. They look at their business plans. They look at their, if they feel they have an idea, they are smart, they give right away. They write you a check for $1 million. But when they write, they own some of your money organizations. Imagine that young Bill Gates, his own company was, $2 million, Therefore, they will write a check to Bill Gates for $1 million. And then they say, hey, your organization, your Microsoft organization is $2 million. We give you a check for $1 million. We own half of your organization. Bill Gates gets $1 million. And then half of the organization, half of Microsoft is his, which is 1 million. Half of it is investment banks. But if Bill Gates is smart, he is not going to get the half of 1 million from the investment bank and runs or spends on, houses or something. He would say to the investment bank, I am not going to get the money out of this organization. I am going to put that $1 million on top of those $2 million. That becomes $3 million. Out of these $3 million, how much of it is Bill Gates? Bill Gates owns only $2 million of it. Then the venture capitalists owns $1 million. Then it becomes $3 million. Do you see? It's a different case than Bill Gates taking the money and put it on his own account. He doesn't take the money out. He puts the money in the company of Microsoft. Now the company of Microsoft, the value is $3 million. Bill Gates owns $2 million. And the company, the venture capitalist, owns $1 million of it, means 2/3 is Bill Gates, 1/3 belongs to the venture capitalist. Bill Gates is smart, doesn't borrow more than, doesn't want more than half of the company to be owned by the venture capitalists, because if they own more than half of the company, they will have the voting rights. They can at some point, dismiss Bill Gates, although the money of Bill Gates stays, but they can manage that by themselves because they own. Therefore, Bill Gates is not going to ask for 2 million and 1 penny, because if he asks for 2 million and 1 penny, the value of the company will be 4 million and 1 penny. And that 1 penny puts the venture capitalist on a driving seat, and they will have the voting rights, and therefore Bill Gates loses his control over the company. Therefore, as a chief financial officer, you have to think about all of this. Now we will talk about venture capitalists in more details. But for now, that was the second investor. We said that the first investor for the companies, for the smaller companies is the first investor, angel investor, just like rich people, like a doctor. The second, that likes to see that you need more money than 100,000 is not important for venture capitalists. They want to come up with $1 million, $2 million to put in your company and become an owner part of it. That way, when you grow your company and become your company, if Bill Gates' company becomes, $100 million, they own 1/3 of it. 1/3 of $1 million, $33 million. They usually put $1 million in hopes that your company becomes big, and their $1 million become $33 million. And of course, Bill Gates, $2 million becomes $66 million, for example. See, this is the way that Bill Gates wants to raise money. wants that $1 million, he doesn't want to take out of the company because he wants to expand. He leaves it in that company and gives 1/3 of the share to the, venture capitalists. Now imagine that Bill Gates is so smart. His company didn't need any money. He grows his company, and his company becomes at some point $100 million without going to the venture capitalist. Okay, now he reaches to a point that needs $50 million. $50 million, that's not a little money. He goes to the venture capitalist. The venture capitalist tells Bill Gates that, sorry, $50 million is a lot of money. We cannot come up with that money. Therefore, Bill Gates goes to investment banks and talks to them about his projects. He says that he has a company, $100 million, and he wants to know whether he can bring another $100 million. That way he can expand, he can go and buy other companies, that way it goes. That's when investment banks come in, and that's how they are going to, provide, help, First of all, the owner of the Bill Gates company, that Microsoft, is one person at the moment, imagine, and that's Bill Gates. Now, when Bill Gates goes to the investment bank can come with some strategies. They might come and say, okay, we are going to give him, imagine Bill Gates needs $200 million, for example. His company is $100 million. Now he needs $200 million. Investment bank says that, okay, they might give him $200 million, which is fine at that time. And remember that the investment banks are going to take the control of the company. Sometimes Bill Gates might say, okay, no problem, because $200 million can help so much to Bill Gates that even his $100 million can grow and become $1 billion. If that's the case, Bill Gates says, no problem, give me the $200 million. He is going to, expand. And what happens here, either investment banks give the money to Bill Gates and own 2/3 of the company, or the investment banks will tell the Bill Gates, don't worry, we have the connection. What we are going to do, we have the expertise. We are going to sell the shares to the public. By selling shares to the public means that they are going to sell the stocks of Bill Gates. They tell Bill Gates, how many stocks do you want your company to have? Bill Gates says, okay, he wants to have 200 shares of the company. If there are 200, let's say 300 million shares. If there are 300 million shares, he has 100 millions of it to himself. That means each share of Bill Gates is $1, because $1 times 100 millions is $100 million. Now he needs $200 million, and he can take this to the auction. Think about it, taking it to the auction. Imagine why someone stands there and says that, hey, everybody, this is a company. Bill Gates is the owner at the moment. He is going to share $1 per share. There are 200 shares are remaining because 100 million of them belong, to Bill Gates. $200 million are out there. And then they start selling each share $1 per share. Therefore, you can go there and you can buy 10 of them. You will have 10 shares of Microsoft. And that is called IPO. Here it is, IPO, initial public offering. That means that investment banks comes and assures Bill Gates. Bill Gates tells him that they have expertise. They can take, it's just like the auctioneers. They are auctioning. They say that, okay, we do all the take care of it. We take all your shares and we will sell them. They will tell him how much per share they are going. These are new shares that they are, issuing. And that means that Bill Gates will have as much as $100 million of it, because that's what he has at the moment. Therefore, they start selling it to the auction. When it comes to the auction, initial public offering, imagine some people come and bid on it. If it is a great company, people come and say, oh, they want to pay because they are bidding on it. They will say, oh, they will pay $1.20 for each share. If that happens, Bill Gates is a lucky man. Do you know why? Because he has 100 million shares, and then his 100 million shares go up the same day of public offering by 20%, because each share has gone from $1 to $1.20. Therefore, that's what investment banks are going to do. They can offer also another, we will continue on this discussion, but they arrange it for Bill Gates. They say, we are going to sell it in auction for you. And sometimes the investment bank might say that they don't have enough power to bring significant number of people. Suppose an investment bank, you might have heard of, Goldman Sachs, and there are a lot of investment bankers are out there. And then sometimes 2 or 3 of them team up together to help Bill Gates to raise his $200 million. They get commissions, these investment banks. They tell Bill Gates, okay, we are going to guarantee, sometimes they guarantee. They say that, listen, if your shares don't bring $200 million, we guarantee that we are going to pay you the difference. That means if Bill Gates, ends up with $180 million instead of $200 million, those investment banks, like Insurer, they put $20 million on top of it to, help Bill Gates. Why do they do that? Because they are getting commission, and because they know that these shares most likely are going to, sell more than $1 a share in the auction. Therefore, that's why they get good commissions. They say, we do it for you, but we will charge you a commission. Let's say you have to pay 5% of whatever you sell to give it to us as investment bankers. Bill Gates would be a happy camper because he cannot bring $200 million, on his own. Therefore, as you see, that helps him to raise capital. As I said, why does he need capital? Is because he wants to expand his own business. He wants to go and buy another technology company. He wants to buy some, open offices. We bring new software and R&D, research and development. He needs money for his engineers, for his computer programmers to do research. He has to hire people. That $200 million, he's getting it. Why he is bringing partners? Because he knows if he brings $200 million, quickly his company is going to go up, and his shares of $100 million in the company will be $1 billion in 5 years. That's great. That's good for him, and that's good for those people who bought his shares in initial, IPOs, initial public offering. Because those who had bought their shares $1, now if shares of Bill Gates from 100 million becomes 1 billion, that means 10 times. Whoever who bought a share for $1, it becomes $10. Shares, that means it goes 10 times, which means if the person who invested $1,000, after 5 years, $5,000 will be $10,000. That's how the stock market work and how investment banks work. They guarantee Bill Gates. And they go there, and they are called underwriters, those, investment banks. The investment banks tell Bill Gates that they are going to sell the stocks that he wants to sell. Although some of them, they might say, we are not guaranteeing. Therefore, in that case, they say, we won't guarantee, but we will charge you less commission. We will do the job for you. We will bring it. If it brings 180 million in the public offering, therefore, we are not responsible. They sign an agreement, and then they say, for that reason, we charge you only 2%. But they say, if you want us to guarantee, you have to pay us more. Therefore, issuing firm bears risk of the sale. If they guarantee it, issuing a firm, that means that Bill Gates, is the one that accepts the risk. If it accepts the risk, therefore, nothing to it. Therefore, there are 2 possibilities. One, investment bank accepts the risk, which is fine. Bill Gates, of course, is not as much in a risk because he still owes his company. His company doesn't go down because, the shares. But his preference is the share when they bring to auction, they are sold more than $1. Because if they are sold more than $1, his shares of $1 also goes up. Therefore, that is how investment banks work. And what they do is that they inform potential buyers that securities, therefore, these investment banks have connections. They call the different brokers. They say, hey, there is a good company. His name is Microsoft. Bill Gates is a smart guy. He's bringing his company. All come to that auction at that time on Tuesday, December 3rd. these stocks are going to be sold. Of course, as you all know, sometimes these stocks might be sold they call it over the counter, computerized. They are computerized. The companies come and become public and introduces price of the security. Therefore, that the investment bank tells Bill Gates, let's start them for $1 a share. Of course, investment bank, usually it is not dollar. Usually they come and say, let's sell them with $100 a share, Bill Gates evaluates and sees that whether it's a good idea. He says, okay, let's go ahead, They decide at how much they should, write. And underwriting discount and recent data. Therefore, we go to the next one. Here it is. And few investors get to participate in an IPO. The meaning of it, I told you that when they want to invest, they want to sell, they sell it. They first contact the big brokers, those investment banks have connections. They call the brokers and say, hey, you are the broker. They call Bank of America and say, there is a good company, but bring your broker, we are going to sell it to you. And the broker says, okay, could you put aside, let's say, $10 million of it for us, Bank of America, we want it for our customers. The investment bank says, okay, we will keep that much, whatever you want, they might go up or down or whatever. Therefore, think about it as, somehow by invitation only, for example. And then, and can be extremely volatile. That means on Tuesday, when the shares in the morning is going to be sold, some people might rush and say, oh, Bill Gates is a smart guy. Let's go ahead and buy the shares. You know that in auctions, when millions of people jump into it and these brokers go and try to buy those shares of Microsoft, the stocks will go up. Or if they have miscalculated, the people think that Bill Gates is not a smart guy, his company might be in trouble, or a bad news comes, Just these days we will talk about the bad news came, and if the bad news come, imagine that suddenly the government has changed, and imagine that, for example, Donald Trump comes and says that he doesn't like Microsoft, and suddenly next week is going to be the publish, it is initial public offering. You know what will happen? If Bill Gates has signed an agreement, they decided to sell the IPO for, $100 a share, and then suddenly the policies change. Then suddenly, instead of selling each share for $1, they might sell each share for 80 cents. And that's why during the first day, initial public offering, the stocks can fluctuate. Suddenly, if they decide to sell it at $100 a share, then during that day, it might go up to $130 or it might go up to $70. It fluctuates significantly. That's what it says. Extremely well. Many achieve substantial returns with high risk. Or it might be such a great company that the same moment you buy it $100, after 1 day, 1 hour, 2 hours, it might be $150. That means your money, if you have 100,000 you put in it, your 100,000 in 1 hour goes and becomes $150,000. Okay, many IPOs eventually fail. Many of them, of course, not a lot of them don't fail, but many do. And here is what happened from 1999 to 2001. In 1999, do you see there were a lot of IPOs here, although it might not show. Do you see these long ones? That's when the .com came. That means that in those days, a lot of technology companies came, and started offering their companies. A lot of people like Bill Gates started new companies. That's when Yahoo started, AOL started, many, companies started. And they offered IPOs. I think in 2006, 2004, 2005, that's when Meta, Facebook came as a public new. Many of you have heard of Mark Zuckerberg. He owned the company, all of it. Then he brought it to the public, and now you can have the shares of, Meta, they call it now. And then that's why in 1999, 2000, a lot of technology companies brought their companies, made them public. A lot of people like Bill Gates were out there and trying to sell their company. But then many of them failed. That's why you see after 2001, these green things have dropped. However, in 2001, 951 IPOs, in 2001, it picked up. That's when the coronas, hit. And then, after, this shows up to 2001. Therefore, we want you to know what IPO is. And each year, now most likely, we have 800, 900 new companies bring their stocks and they sell them. And here it is, 2,000 value of IPOs, and it is the money value. Here it talks about the money. Secondary offering. Secondary offering means that after, subsequent of sale to the public, that is, IPO is the first offering. First offering is just when, think about a car dealer sells the new car to a new owner. The IPO is just like a new, the first time the stocks are being sold. After you buy the shares, you imagine that you were lucky, you could buy some shares of, Microsoft from, the investment bankers. Now, after 2 days, you feel that, you make 50% on the $10,000. You decide to sell it. If you decide to sell it, who is the buyer? Who buys it from you? That is called secondary market, secondary market. You just go there to brokers. The brokers are everywhere. Charles Schwab, a lot of, brokers, Fidelity, Vanguard, you have an account with them. And then your shares are in those companies. They are just like saving account that you have. Those companies, your shares are there. You tell them you want to sell them. Therefore, that's a secondary market. You bought in IPO $100,000, your $100,000 became $150,000. Now the secondary market is like a used market. Doesn't mean that used here we know used cars are less expensive. That doesn't mean used market, secondary market are less, than for a primary market. The first, initial offering. Therefore, that goes. And then securities sold as funds are needed. Therefore, Bill Gates is one lucky man. He got $200 million and now he can continue. His company becomes public. Because it becomes public, from now on, Bill Gates cannot hide things from the public because his company is public. If before he could hide how much he makes, but now he has to report it. Why report it? Because now we have thousands of people who have shares of the company and they have the right to know what is happening in the company. Of course, he doesn't need to tell all the secrets, There are certain things that the companies can not to disclose, but there are things that particularly every 3 months, they have to report their quarterly reports. And that is today, as I said, Apple is going to do, its quarterly reports for the 3 last months of the last year. And as I said, anyone who posts first gets the news and tells that what the news is, and writes a little bit, 1-2 lines. Apple was, declared that it was better than expected. Their profits, their sales, their iPhones, something, that shows you are the first, you get 5 points. And I am, we come here. Amazon issued a stock through investment bank. Amazon, in 20 years, 25 years ago, it did. And then a lot of people became millionaires because they bought Amazon in early days. If you put, in 1999, 2000, I think, when Amazon went on public, if you had bought their stocks, even not in the IPO, the next day, in secondary market, you bought it, invested $1,000. Your $1,000 today most likely would have been $1 million. That's a lot of money, And then we come here. This is a secondary. Amazon has previously issued security and is currently a public company. That's something we used example of Bill Gates. That means that Jeff Bezos, who was the owner of Amazon, needed money and to expand. And because he needed money, he brought the coin. It was a smart idea. If he had not done it, he would have been a billionaire. Maybe he had a few million, $100 million. But because he made it a public company, he brought in more money of the investor. That way he could expand, make it an international company and buy a lot of companies. And, that's why the companies bring their companies to and make them public because they can get a lot of money. People have money to invest. They give it to Amazon and they become the owner. And therefore, one more thing I want to say, we will talk, is that Amazon also not only get the money from the people, it borrows also. When it sells the shares, it is not borrowing it. It is financing through equity. That means he gives part of the ownership to people. That means one company might own 1% of the Amazon. Jeff Bezos might have owned 10% of Amazon. Therefore, here we go. Private investment, non-public sales of the company, venture capitals come. Do you see that these venture capitals usually are involved in non-public? Non-public is that they are not bringing to the public auction that is regulated by the federal government. If I am buying stocks of a public company, it's better to be regulated by the federal government, because if Bill Gates is crooks, who is going to catch him? Someone has to watch Bill Gates if I am the owner of his stocks of Microsoft. Therefore, that's when Securities and Exchange Commission comes and regulations and Federal Reserve. They are all monitoring that the chief financial officer of Microsoft and Bill Gates are not crooks, and they are honest. However, sometimes Bill Gates might say he doesn't want to make his company public. He wants to make it private. Therefore, goes to these venture capitalists. And the venture capitalists say, okay, we don't take it to the stock market, but we know we have some money we give you. You have to tell us about the secrets of your company, but the people cannot shares of your company. However, we buy it. Bill Gates is allowed to sell shares, but either he will sell it to the public. In that case, his company becomes a public company, or his company has a share privately, sells it to the investment banker. Therefore, the company will have only two owners. One of them is Bill Gates. One of them is an investment banker. With venture capitalists. And then, in that case, that venture capitalist, as I said, might not have $200 million. It will go and bring another venture capitalist, and both of them put, let's say, one of them put 100 million, another one puts 100 million. Bill Gates has 100 million. Now we have $300 million. The company, the money that Bill Gates needed, now it can operate, but this time it is not being traded. That you and I cannot go and buy their shares because it is private. Okay, and it's written reduces selling costs. I saw. Which means when Bill Gates goes to, I don't know, I missed that. When Bill Gates goes to, here you go. When Bill Gates goes to venture capitalists, he is not going to investment banker, because investment banker is smart. They get their commission. They might not be the owner of the company. They are selling it. They are just like broker, like a real estate agent, bringing buyers and sellers together, and, they get their commission. But here, venture capitalists are not like, are not real estate, agents. They are like, themselves like buyers. They buy it for themselves because they think that Microsoft is a good company, and because they want to, make a lot of money. And then we come here and we come, a SPAC, a special purpose acquisition. In fact, Donald Trump got involved in a kind of SPAC, SPAC. I don't want to spend time on it. If anyone goes and finds that information and shares it and responds to, Dow Jones, where I put the first person who puts that, what's the deal of Donald Trump's SPAC where he started? It's more about the Truth Social, some of you have heard of. The first person who puts the information about the SPAC gets this message, tells me he or she has listened to this lecture, and posts it on the discussion board where I say Dow Jones, clicks respond, and put the information. What was the SPAC that Donald Trump got involved regarding his Truth Social? And then that way we read about it, and the students, I give 5 points to that student too. Regulations of public and corporate. Therefore, we know that when the company becomes, public, That means Bill Gates sells the shares of Microsoft to public. It has to have full disclosure about what he is doing. He has to provide annual report, because he is not the only owner anymore. Now I am the owner because I have 2 shares of Microsoft. Maybe you have 1. He is supposed to. You are the owners. You are supposed to know what's going on with the company, and he cannot violate any rules and regulations. We come here and will not clear for until materials fact the effect value of the securities enforces SEC, Securities and Exchange Commission. This is an organization of 5 commissioners, 5 people. These 5 people all are good in finance. They know about stock market. They are in Washington, D.C. It's a federal government agency. And guess what? They say that in SEC, they have the most educated people of the federal government. Everybody in there is either lawyer or accountant, with a lot of experience. If you suddenly go and be hired by SEC, work for them for 5 years, 10 years, guess what? All the companies come to you and beg you to hire you because they know you have a lot of experience. Therefore, there is this organization. Think about the SEC as the IRS. IRS, collects money. But this SEC is a kind of monitoring organization, bring laws, talk about securities, what the companies are supposed to do, how to file, their information. If they are not there, all these companies, are going to act like crooks, They are going to cheat the shareholders. This is security. Therefore, where security federal will not clear security for until that means when Bill Gates wants to sell his stocks of his company, SEC comes and looks at it to make sure that he is not lying, to make sure that he's not going to cheat, make sure suppose if he comes and says last year he made $1 billion, $100 million, $20 million, the SEC wants to make sure that he is not lying when he brings his stocks, for public sale. Doesn't comment on worthiness of securities of an investment. That means that Security Exchange Commission doesn't tell the people, go and buy this, stocks of, Bill Gates. It doesn't, and can suspend trading. If they find out that Bill Gates is crooks, and they can bring a law and say they decide to stop Bill Gates from trading. And investor securities, this is another organization that monitors. And guess what? This one is more like an insurance company that covers up to $500 million. You all have heard of FDIC for the banks, that insures the money of the depositors in case if bank goes bankrupt. Therefore, for securities, there are similar insurance that is SIPC. Brokerage firms can carry additional insurance, which means if your stocks are invested in Microsoft, and imagine you have used Berkshire Herbert Bank, you have used Charles Schwab, and then suddenly what happens if, let's say, Charles Schwab go bankrupt? If I am the owner of shares of Microsoft, of course, my shares of Microsoft, the company of Microsoft hasn't gone bankrupt. Therefore, even Charles Schwab, the broker, goes bankrupt, my shares with, Microsoft is still safe because ownership. It's just like you go and buy a house. And, every document of it is in the courthouse here in Moorfield. If, let's hope not, something happens in the courthouse, a fire or something, and all these documents get burned, that doesn't mean I have lost my house. I still own my house. Do you see that? Therefore, it's a different case than when it says this $500,000 is, let's say, Charles Schwab suddenly gets involved in some crazy things. They, if they do unusual things. Therefore, I have been insured by $500,000 of, to protect my investment. And then these are, again, government acts to make sure the people are not cheated, those you and I, that the corporate, that means Bill Gates cannot get involved in, they watch Bill Gates. And we come here again, these are the names of the senators. Dodd was a senator, I think from Connecticut, and Frank, therefore they came, and there was a Frank, was a congressman, I think also was Frank, but I know that this was a senator from Connecticut. They brought some laws to make sure in 2007, 2009, to make sure that the Bill Gates company are financially stable. If they find out that the company is shaky after, they want the people know about it, which is great. This is good. These regulations and discussion what two basic methods, and looks like we got hopefully we discussed about it, and hopefully you get some information from this discussion.